Assalamualaikum warahmatullahi wabarakatuh and a very good morning to all. So we are from group 2 and we will be presenting our provided topic, which is topic 3, business income and losses. My name is SOFEA binti JASMI and my matrix number is 261115. These are the subtopics that we will be presenting today. The first one is capital receipts and revenue receipts. The next one is adjusted income from business, section 33 and 39 of ATA. And the last one is derivation of business income, section 12.
Assalamualaikum warahmatullahi wabarakatuh. My name is MOHAMAD NASARUDDin bin MUDA 264803, and I will explain on part 3.2, which is capital revenue and capital receipt. So what is capital revenue and capital receipt? Capital receipt is any amount received as compensation on surrendering a right, whereas any amount received for loss of future income is a revenue receipt. Capital receipt are to be charged to tax under capital gains, and revenue receipt are taxable under other heads. It is of vital importance to understand which receipt is a capital receipt and which one is a revenue. Some tests, however, can be applied in particular case. These tests are: first, on the basis of nature of asset; second, termination of source of income; third, amount received in substitution of income; and lastly, compensation received on termination of lease or surrender.
Assalamualaikum, my name is Muhammad bin HADI. I will continue the presentation on subtopic 3.2.1, which is sales of technical know-how or secret process. What is the sales of know-how? Sales of know-how are generally in the form of secret process, design standard, drawing, or pattern. Whether sum received for the sales of know-how is a revenue or capital receipt will depend on whether the owner has imparted an enduring asset which will substantially reduce the value of the asset to the owner. For the capital receipt, if the owner imparted the know-how as an element of a comprehensive arrangement by which the owner effectively gave up his business in a particular area, the money paid for the know-how is a capital receipt. The case that related to the capital receipt is Given Medical Supplies Limited versus Moriarty. The taxpayer company carried on business as manufacturer of pharmaceutical product and located in Burma. Under an agreement with the Burmese government, the taxpayer company needs to supply the government with information relating to the manufacture of pharmaceutical product, as well as secret process, technical data, drawings, design, and plan for the erection of a factory and the installation of the machinery. As consideration for undertaking, it received a capital sum of $100,000. The House of Lords held that the whole of the $100,000 should be excluded from the computation of the company profits, since even Medical Supplies Limited part with the asset and it has never entered into any other agreement with any other party for the disclosure of technology and secret process, it can be reasonably argued that the money received is not taxable and is a capital receipt. Okay, for the revenue receipt, if the owner disposed of the know-how without parting with an asset or benefit of an enduring nature, the exploitation of the know-how will be treated as arising in the ordinary course of business. Under the above circumstance, the imparting of know-how is no more than a service, no matter how special it is. The case that related to the revenue receipt is Jeffrey versus Rolls-Royce Limited. The taxpayer entered into series of agreements with nationalist China, France, and the United States, Belgium, Sweden, Argentina, and Australia. Under this agreement, the company undertook to supply drawing, manufacturing, and engineering data, and other information. Payment made under the agreement include lump sum and royalties. The House of Lords held that the lump sum were trading receipts which should be brought into charge to tax as income and is a revenue receipt.
Assalamualaikum warahmatullahi wabarakatuh, and hi everyone. My name is Syazani Damia binti Radzaini, matric number 261116. I will continue with subtopic 3.2.2, sum received by way of compensation for three situations that we will explain. First is satirization of asset. Second is payment of destruction of asset. Third is payment of serious business asset. From these three situations, in the case we need to determine whether the case is capital receipt or revenue receipt. Okay, first, satirization of asset. The principle involved in satirization is to stop the operation. Asset is still there but cannot continue the production. This means is asset is still in the business but there are order to stop the operation. Okay. For the factor for the capital receipt, first is permanent loss of income earning, not a profit earned from the ordinary business. Example case is Cambridge Union versus CIR. For the revenue receipt is the compensation paid received is payment due to delay in repair, and value of asset is remain intact. Intact mean is in the period of stop the operation, there is no missing component or destroyed. Okay, example that I will explain is Cambridge Union versus CRR. The appellant company carried on business as manufacturer of fire clay goods and as merchant of raw fire clay, and was leased by Caledonian Railway. In 98, Caledonian Railway prevent the appellant company to working part of the fire clay, and they paid the compensation. The House of Lords held that the amount of received for compensation in respect of the fire clay left unworked was not a profit earned in the course of the company trade. So this will determine that this case is capital receipt, being a payment for the satirization of capital asset. Okay, second station, payment received for destruction of asset. Okay, the disposal is deemed to occur when a capital sum is received in respect of any kind of damage or injury to the asset, the loss, destruction or dissipation of asset, and any depreciation or risk of depreciation of asset. Okay, for factor for capital receipt under this situation is also permanent loss of income earning, and in the destruction of asset there is physical damage. Example case is London and Thomas Heaven or Varvers versus Atwood. Okay, for the factor for revenue receipt is earning from the compensation is replaced for the loss of profit during the temporary period, which is cannot use, the asset is cannot use temporarily. Example case is Ensign Shipping versus CIR. Okay, I will explain for case Ensign Shipping versus CIR. Two vessels in this shipping owning company were temporarily detained for period 15 and 19 respectively, in port by order of government. Compensation paid in relation to replace the loss of profit. The sum received were held to be trading receipt. Okay, in this case we can see the factor for receipt, revenue receipt, which is cannot use in temporary period for two vessels. For one is 15 days and another one is 19 days, and also the compensation was paid for the replace loss of profit on the
that period. Okay, lastly, payment for sales of business asset. Receive arise or occur from taxation carried out in ordinary course of business. Okay, example for this station is example case Marmos Neighborhood versus DGRR. The taxpayer carry on the business of planter and cultivator of oil palm. The company was required to move the timber from the land that they buy before they want to plant the oil palm. The taxpayer enter the agreement with the contractor to extraction of the marketable timber. The tax authorities assess the taxpayer on some received income from the from the extraction and sales of timber from that land. In hell that some receive its cost of development of the land into the oil palm plantation. Thus, the company was not carry on the business of timber operation. From this case, the factor of this situation is Marmos Neighborhood is not carry the business of timber operation. Their business is on planter and cultivator of oil palm. So the income that is the income that from extraction and sales of timber from the land is a capital receipt. It is not taxable.
Hi, I'm ALISHA FARHANNA. Metric number 261100 will be explaining about the adjusted income from a business, section 33 and 39. Section 33 of Income Tax Act 1967 states that a person's gross income shall be adjusted by deducting from that source all outgoings and expenses wholly and exclusively incurred in the production of gross income. But not all costs are deductible. Section 33 must be read with Section 39, which provides a list of outgoing expenses that are specifically non-deductible. This list includes domestic or private expenses, any capital withdrawal or sum employed or intended to be employed as capital, payments in respect of provisions of provident, savings or similar funds or societies which are unapproved. So let's see the case that relates to this section. Real Estates Limited versus Income Tax Commissioner. In this case, Real Estates Limited are the appellants and Income Tax Commissioner are the respondents. The issue is it concerns the income tax payable by a company named Real Estates. The company made considerable profits and it is liable to pay income tax. However, it says that in calculating the income, there should be deducted several payments. The Commissioner of Income Tax declined to make any deduction. The company appealed to the High Court, and the High Court said that the payment were not in revenue expenditure, but it is in the capital expenditure and were not deductible for the purpose of the income. So, in the conclusion of the case above, the payment made for the purpose of generating capital are not deductible. However, where the payments are for the purpose of generating income, there are revenue expense and would be deductible under Section 33. Outgoings and expenses referred to by Section 33 must, strictly speaking, be revenue in nature. It is not capital expenditure. Even if your expense falls into Section 33, it must be non-deductible if it also falls in Section 39.
Next, I will continue the presentation with 3.3.2 Initial Request. As stated by ALISHA in 3.3 Adjusted Income, Section 33 of ATA 1967 must be read with Section 39, which will explain the deductions that is prohibited to be deducted from the gross income. Section 33 Clause 1 describes the characteristic of the expense that allowable to deduct, which it should be an outgoings and expense which is wholly and exclusively incurred in the production of the gross income. As stated in Section 33(1)(d), such other deductions as may be prescribed is the deductions that empowers by Minister of Finance, which will be updated from time to time. Other than that, the deduction sometimes not allowable under ordinary rules, but in view of particular economic necessity, it can be allowable. This means that some deductions are not listed in the ITA also can be deducted in some relevant situation. Here is the list of the prohibited deduction that can be deducted from the gross income under Section 39, Clause 1. However, other than the deductions stated in Section 33, there are also some deductions provided in the Act, which is stated in Section 34. Section 34, Clause 2, the bad debt can be deducted from gross income in two situations which are irrecoverable and partly irrecoverable. For the irrecoverable bad debt, the amount that can be deducted is equal to the amount of the bad debt. And for the partly irrecoverable, the amount that can be deducted is based on the estimation of how much the debt is irrecoverable. Next, Section 34, Clause 3 defined the bad debt related to the deduction, which stated that the debt must already been included in the relevant gross income that made it qualified to be deducted if it is not recoverable. Section 34, Clause 4 stated about the employer's contribution to an approved fund for the employees. Based on this section, the remuneration made by the employer consists of two types, which are remuneration as a whole and partly deductible. For a whole remuneration, the deduction is up to the contribution or 90% of the employee's remuneration, whichever is less. And for the partly deductible, deduction is based on the part that is contributed by the employer to his employee. Section 34, Subsection 5 stated about the special expense incurred by the business for the employees that is engaged in activities relating to the production of the relevant gross income, which is not stated in 34, Subsection 4. But it may be qualified to be deducted from the gross income, which should be under the concern of Director General first. Lastly, the Section 34(7), the deduction discussed is related with the research and development expense incurred by the business that can be deductible from the gross income. This means that every expenses related with R&D of the business, which is different with the expenditure incurred to set up the business, can be deducted under Section 34(7).
Okay, now I will be explaining about the derivation of business income, Section 12. Generally, the income shall be deemed derived from outside Malaysia if the income is attributed directly to activities conducted outside Malaysia. Therefore, if the gross income is related to the work performed outside Malaysia and the taxpayer wishes to treat it as a foreign source income, the taxpayer would need to validate that it is attributable to operations of business carried on outside Malaysia, meaning there need to be an evidence to validate the operation of business. Okay. Section 12, subsection 1 says that if the taxpayer cannot prove that his or her business operation is conducted outside of Malaysia, it will be considered to be conducted in or from Malaysia. So let's look this case, DGIR versus Aneka Jasa Ramai Express. Income derived from the sale of bus tickets in Singapore for journeys which come from the Singapore bus drive into Malaysia is not income derived from Malaysia. This is because there is no evidence to support that the income is accrued in or derived from Malaysia, but there is an evidence that the income is derived in Singapore. The income received from this operation is not from Malaysia, therefore not subjected in Malaysia income tax. While Section 12, Subsection 2 says that any dividend or interest income which relates to a business in Malaysia will be considered as Malaysian income and therefore subjected to Malaysian income tax. Special Commissioner of Income Tax versus DGIR 2012. Regarding the source of income, the Special Commissioner of Income Tax, the High Court and the Court of Appeal has stated that the interest income derived by a taxpayer from loans made to an offshore entity is foreign source and therefore not subjected to Malaysian income tax. Here, the DGIR argued that the interest income was in fact sourced in Malaysia as the funds were generated from business activities of the taxpayer in Malaysia and transferred from the taxpayer's bank account in Malaysia. The Court of Appeal states the judgment of the High Court that the source of interest income is located where money was lent, and it followed that what had been done to earn the income was the placement of the funds in the Netherlands. Therefore, the interest received by the taxpayer from its related Dutch company is foreign source income, hence it is not subjected to Malaysian income tax. Here are the Section 12, Subsection 3. It says that other than the derivation of business income stated in Section 12.1 and 2 of the ITA, the income of a person who has a place of business in Malaysia will be subject to tax in Malaysia. Section 12.4 provides a list of what will be included under a place of business. So this is the example of place of business that is subjected to tax in Malaysia. We can see firstly a place of management, a branch, an office, factory, workshop, warehouse, building site, construction, farm or plantation, mine, oil, or any place of extraction of oil. So this is the end of the presentation. Thank you.